advising clients across the country. Here he is, your host, J. Christopher Boyd.
Thanks for being with us for Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner, and our office is Asset Management Resources, a registered investment advisor firm. Joining me again today is Jeff Perry and Brian Regan, both of Asset Management Resources. Thanks for joining me, guys.
Great to be here.
Good to be here.
Recently, Brian, we had a client webinar, and I wanted to spend some time talking about that and some of the ideas mentioned in that. We, just for our listeners, want to let you know, for our clients, we do a webinar each quarter on what's been going on in the markets and the economy, sort of looking back initially and then looking ahead to say, what does this mean? How should we be positioning? How should this affect our strategies? And so we kind of share with our clientele and anyone who cares to take a look, sort of how it's affecting the way we think about our marketing, our market positioning, and so forth. So we had one of these. In addition, by the way, we also do a webinar with some of our financial advisors on more financial planning-oriented topics typically. So we have another one of those coming up in September. The retirement red zone. It'll be football season by September, so we're getting in that mindset. So in any case, but that idea of getting close to retirement, how do you get ready for it? So we'll talk about that. If you're interested, you can always register through our website. We have a section on our webinars, and you can register through that.
What is that?
Is the website.
AMRfinancial.com, right.
Don't forget to tell the website.
I know.
Yeah, as I move right along. So in any case, thanks for that prompt. Well, let's get to it though. Brian, you had a very, I thought it was jam-packed with content. I was a little initially when I was reviewing, I was thinking, how's he ever going to get through all this backward-looking stuff? We've already, it was the initial when you had all these like kind of getting us to, how do we get to where we are, And I thought, he's never going to get through all this stuff. Made it through it all at a very reasonable tempo, reminded people sort of where we've been, what we've been up to, and sort of where that leads to, where are we at and what can we expect. Where would you like to begin talking a little bit about some of these issues?
Sure. So I don't know if you guys Chris, I know you did. Jeff, I don't know if you did get a chance to read the Investor Insights letter that I write. It's kind of in conjunction with this webinar that we do every quarter. But the whole theme of that was about false or exaggerated narratives that happen in the investment realm that can distort markets. So, I go through some historical ones and I throw some fun ones about my toddler in there, and that's on the website for anyone to read. But the whole crux of it was, I think that in 2022, we had a bit of an exaggerated mania over inflation. We've been saying on the radio, for regular listeners, they probably know that we expected the inflation situation in the last 2.5 years, similar to the 1946, 1948 inflation problem that happened following World War II. I thought there were some similar parallels there. So the reality is that is what the grand scope of the business cycle that we were looking at. We had to take kind of two looks at the portfolio, right? If we separated them out, we had one part of the portfolio that was going to be inflation protection, and another part of the portfolio that was going to be taking advantage of the recovery. So I called this colloquially limiting pain and setting up for recovery. And the reality is we had to do a lot of things to limit pain in 2022, while also maintaining this setting up for recovery stance, which was a little bit controversial at the time, and right now, I'm really happy that we were able to keep that stance in the portfolio. So as inflation was rising for all the reasons that we know. Loose monetary policy, a lot of government spending, supply chain issues as people switch from goods from services, et cetera. We saw as inflation went up, we took less interest rate risk on our bond portfolio. When as inflation went up, we took less beta in our equity portfolio, which is just relative volatility versus the market. And finally, we were underweight equity. So that was our defensive stance in our portfolio. But at the same time, we recognized that this inflation was probably going to break, right? Our thesis was that it was going to be 2.5 years. At some point, the market was going to realize this as well. But, we're not very good at timing the market. We don't pretend that we're capable of doing so. So our stance was to make sure that we had some assets in there that we're going to be able to rally hard in the face of falling inflation. So we had that as well. It was, very easily just NASDAQ type positioning, if you want to think about it that way. And on the bond side, we maintain some intermediate duration bonds. So if you look at our target duration, which is a measure of interest rate risk, it's a line down throughout 2022 into October, and the line starts ticking up in October, and it's all very purposeful. So
which incidentally was where the market bottomed. Just for people who don't recognize that.
Yeah. So this is the active allocation approach that we have. It's not all in, it's not all out, but we recognize what's happening in the market and we reposition the portfolio, accordingly, within your risk tolerance, within your preference, something that you could stick with for the long term, so you can, do well. There's tons of evidence that finds that if you just find what your risk profile is, your risk profile is basically the asset allocation that you'll be able to stick with through thick and thin, you're going to do very well. And then, we tinker and we make changes within that risk profile, which is exactly, what I just described. And then finally, what do we see going forward? That was all in the past. Well, we got this big rally from the mega cap growth stocks that we know and that we've enjoyed. But the reality is that there are other different kinds of stocks that will benefit from a falling inflation and falling or stable rate regime that haven't caught up. And our positioning for the third quarter is going to be to start to move into those sectors, which are small caps and high dividend yielding type stocks, which in the S&P 500 there's a lot of very attractive dividend stocks right now, and in small caps they just haven't come anywhere close to catching up with large caps, which makes sense in a higher rate environment. They typically tend to be cyclical companies that are more reliant on debt and interest rates. So it made sense to stay out of them until this point, but with that interest rate regime ending and the steep valuation discount that they're in, it seems like a good opportunity to move into them a little bit.
Brian,
so good, Jeff.
Brian, how are you viewing bonds moving forward? You've discussed how you've positioned ourselves, but what's your outlook moving into the second half of this year?
Sure. So we are predominantly in investment grade bonds. We'll start there. And that is because of the banking issues and credit tightening that we're seeing throughout the economy. We don't want to be too exposed to high yield. We think there will be a better opportunity if spreads widen out. And, when we left high yield a quarter ago back in March during the regional banking problem, I said it's see you later, not goodbye. We do add a lot of value by, adding high yield when they're cheaper. Right now, spreads are fairly tight, relatively tight, but they've done very well. Now, within the investment grade space, we like to target where what I call the fat part of the curve, which might not be politically correct, but the fat part of the curve, the part of the curve that is getting the most return for the least incremental risk, which still right now is 3 months to 1 year. So that our heaviest position is in a investment grade bond ETF that targets that area. Now, the 10-year Treasury is at around 380, 390 today. The longer term inflation expectations is around 215, 220. That is a spread, a real yield of around 160, 170 basis points. It's a little higher than the historical norm, So we think if they revert back to the historical norm, there could be some opportunity for longer term gains inside of Treasury securities. There's certainly no or longer term Treasury investment grade assets. There's certainly no guarantee of that. There is a chance that we could stay higher for longer. The economy could stay strong, and Treasury yields continue to float a little bit higher. That's very much a big possibility. So we don't want to be too overextended there. But it is an area that we are invested in, less so than the shorter part of the curve. And finally, and I guess this would fall into the quote unquote high yield bucket, but it's not the typical unsecured corporate high yield that you're thinking of. We are an emerging market sovereign debt, which has a nice yield. Should benefit if the dollar falls, which if inflation falls in the United States and doesn't necessarily fall as quickly throughout the rest of the world, we should see some dollar weakening, which should benefit this asset class. So between that, the possibility of falling longer-term yields, we think that's a good place to add in the bond portfolio to get some additional return.
Thank you.
I wanted to go back to some of the comments you made earlier talking about valuations a little bit, and I think it's worth reinforcing and maybe celebrating a little bit as well. So when it came to in the midst of last year's difficulties, you looked at several kinds of companies that are these companies that were under pressure. Some of the big names people know. And you said these companies are getting punished too much. Let's overweight some of these while they're down and buy them a little more cheaply, because when we recover, we're going to see a much better return from these companies, because they're quality companies that are going to recover nicely on their price. And that's exactly what happened this year, as we've seen some of these large cap growth names, these mega cap names really take off and do well. You referenced it more along the lines of the NASDAQ kind of names that people might know. And yet, when we look at them today, I think part of what we'd say is, gee, maybe now they've gotten a little bit extended. And so it's been a thesis that paid off and worked well. And you were saying that there are other areas of the market where there may be greater opportunities, greater attractiveness, because their valuations look less extended, more inexpensive. We often refer to some slides on the JP Morgan asset management reference. It talks about the forward PE ratio, the price to earnings ratio of the market. It's again a little bit elevated relative to its long-term average. But let's talk a little bit about some of these places that you're pointing to where there's greater opportunity now as investors look ahead.
Sure. So I want to caveat this whole conversation by saying you shouldn't spend too much time on PE. I wrote a whole article on why the PE is
only one measure of valuation, and
not a very good one either. And I think that's one of the big things that people got wrong about this mega cap tech rally. If you think about what's really important, right? It's cash flows, which what I typically just call earnings for the sake of simplicity when I talk about valuations. It's cash flows, it's growth, and it's consistency. If you can be consistent for a long time, you're going to have a higher valuation. There are new innovations in the economy that make the longer-term PE ratio should be higher than the average. For example, we have subscriptions. We have subscription accounting now. We're not a bricks and mortar economy anymore. We're a bytes and bits economy. And what does that mean? Like you don't pay for something up front and then replace it again 3 years from now. What you do is you pay for it all over time. So the cash flow stream is much more predictable, and there should be a premium to that. And there is. So when we talk about Amazon, for example, trading at some outrageous price to earnings ratio, one of the things that you need to remember is They have prime. Prime. People are addicted to prime. I'm addicted to prime. They could raise price on prime very significantly if they wanted to, and they could goose up that earnings number. They have a huge depreciation expense on their balance sheet. That depreciation expense is mostly real estate. What do we know from real estate? Just everyday person on the street. It's just as likely to appreciate as it is to depreciate. There should certainly be some capital expense there, but those are just some small things to keep in mind. Now, that being said, on the whole, they're certainly more expensive today than they were 9 months ago. So I know inevitably that certain clients and certain listeners are going to be more excited about the stock market, today than they were in October. Which I just want to remind people that that's the exact opposite way to think, right? You should be excited.
Well, that's why you want someone who thinks the way you do to be a part of the process, because we tend to want to do the wrong thing. We tend to want to sell when it's low and buy when it's high, but we really, we all know that you got to buy low and sell high.
Yeah. So that's a long way of saying, hey, look, Chris, you're right. I mean, the NASDAQ ran 40+%, right? It's got to be a place to be excited. People are really excited, right? Yeah. To me personally, I'm more interested in what hasn't moved and what can move in the future. And that comes to, small caps that are trading around 11 to 13 times earnings right now, if you want to use the price to earnings ratio. But more importantly, the ones that do survive this interest rate environment, they're going to be in a much more secure place going forward, because they're probably going to have an idea of what their borrowing costs are going to be. And if we don't go into a recession, they're probably going to have, some good demand. And then in the high dividend yielding space, I mean, we're looking at 5 to 6% dividend yields. I think, historically the S&P 500 pays between 1.5% and 2% dividend yields.
Yeah.
So,
yeah.
I don't concentrate on dividends per se. I'm constantly preaching total return. It doesn't matter if you get your return from capital appreciation or from dividends. In fact, it's probably better in capital appreciation because it has a better tax treatment. I want to maximize your return. But when you're getting dividends before any growth of 6%, 5-6%.
Yeah, and they seem relatively inexpensive.
Right.
That's a good combination for a recipe for success.
Right. So I can either clip that coupon.
Go ahead.
I can either clip that coupon and collect my 6%, and maybe I'll get 2% growth, or the market will correct, and I'll get that capital appreciation from people realizing that these dividend yields are very high, and in a falling interest rate environment, they're only going to get more attractive. So I'll take either one.
So you anticipated my question. I was going to say, what's the catalyst that moves the needle on these to how we get our profitability? What about in the case of small company stocks? You mentioned small cap as not having participated the same way that the large cap stocks have so far. What's going to be the driver that starts to move small company stocks from where this lack of participation to a greater participation?
So it's already started happening. Luckily, even in that strategy that we mentioned that has been slow out of the gate over the last 12 months, it's been very much in the black. Might not seem that way because 2022 was such a tough year for it. But we have seen some momentum. And I think the momentum is caused by the acknowledgement that the Federal Reserve is coming to an end here. So it's going to be a better interest rate environment for these companies to finance their businesses, and ultimately that's my premise.
Brian, we don't talk too much about it, but most people when they're thinking about diversifying a portfolio, at least discuss or contemplate adding some international exposure. Where are you on thinking about outside of the United States for investing?
Sure. So we do utilize an international fund, and this has been a hot question lately. Mm-hmm. We utilize an international fund that's about 15% of our portfolios, give or take, but it takes more beta
of the equity exposure.
Yeah, it takes more beta than the equity ex-US. And
you're going to have to explain that to 99% of the people who just heard that.
Sure. So the ACWI ex-US is just basically the international stock market index, right? Think of it as the total stock market for international stocks. So if it has a beta of 1, that's the natural volatility of those stocks. You know, if our fund has a beta of 1.2, I'm expecting it to be about 20% more volatile. So I'm going to capture 20% more of the gains, and I'm going to capture 20% more of the losses in theory. So if I have a 15% position, but it's 20% higher, you could think of it as, you know, I have something closer to maybe an 18 to 20% position in international. And it's, you know, a way of, you only have 100% to allocate, and it's a way to get your allocation up a little bit. And the reason why the beta is a little higher is it's a growth stock. It's a growth stock fund. And most international stocks are value oriented, right? The United States is very heavy in technology and communications. That's just not the case internationally. It's not that they don't exist. It's just it's not the primary driver of the stock market. So if you want to look at international stocks, you often have to compare it to a value index. We also don't invest in China at all, and that's a big part of the ACWI ex-US, or very, very, very minimally. The reason for that is we just think that there's a lot of we think there's too much capital control. You know, it's almost how much do you trust the Chinese government will let you get your money back? So, you know, we invest there. We think it's a great diversifier. We're very happy with the fund that we've had. We changed it about a year ago because, you know, we care about being in the best fund you know, in the space that we want to allocate in. And that change has been very good to us.
All right. Well, as it turns out, join us for a future episode of the program where we're going to be talking with Jeffrey Kleintop. He is the chief global strategist, investment strategist and managing director with Charles Schwab. And so one of the things he's going to be focusing on is what's the role of international investments and where there may be opportunities within that space. So we'll look forward to that coming up. Additionally, you know, while we're taking a moment here, I want to just step back and say, you know, you get the sense that we spend a lot of time on thinking about these issues and trying to identify how best to be positioned within a client's risk tolerance. But, you know, overall, how do we want to position our portfolio? And we've developed a strategy, a reference to the way we approach our portfolios as active allocation. Now, it's very much an asset allocation approach where we want to pay attention to risk being driven by where we put, you know, how much we have in stock versus bond or whatever the different asset class exposure may be. But we are active in the sense that we do make adjustments. We think that some of these, paying attention to these decisions can add value. And so as you listen and you're perhaps considering, am I getting this same level of attention to my portfolio, whether I'm doing it myself, use an index approach, or whether I'm working with another advisor, you may be someone who would benefit from a consultation and a second opinion to see how would things be done differently if I worked with another firm. So not that you're obligated, but if you'd like to have the opportunity to speak with us for a complimentary consultation, you're more than welcome to reach out to us through our website, amrfinancial.com, or you can give us a call at our telephone number, 866-771-8901, or locally, 508-771-8900. We started off this segment mentioning the benefits and of our clientele getting the benefit of a webinar each quarter. Brian went into significant detail with visual slides and so forth. If you'd like to benefit from some of that, you can find it on our website and check it out there at amrfinancial.com. Guys, thanks for everything. I don't know if there's anything else we meant to talk about, but I think we've covered it. What do you think?
Good job, Chris.
All right. Good job, Brian. Good job, Jeff. Thanks, guys. Appreciate it. Again, if you need any help, reach out to us through our website, amrfinancial.com. But don't forget, You can follow us on social media. We're on, Jeff, I don't know, how many social media platforms are we on?
All of them except for TikTok. Facebook,
Yeah.
Twitter, Instagram, YouTube, LinkedIn. I should have said Twitter. I guess it's X now, but we're on all of them except TikTok. I can't convince our CEO to get on it.
No, that's not happening. I'm not dancing for you all. I'm sorry. But anyway, no, I'm teasing. So in any case, but if you'd like, and you've been doing some reels, you said, with something on your
Yeah,
own.
we've been sharing a lot of videos and a lot of attention on YouTube. If people want to catch up on old episodes or see Brian's former webinars, go to our YouTube channel, which you can get off of directly from amrfinancial.com and click YouTube and check us out.
Yeah. Additionally, if we hope you are listening on podcast, but if you happen to be listening by radio, be aware we're posting our show on podcast, sometimes even before it airs on the radio. So check it out on our various podcast locations, whether that's Apple, Amazon,
Spotify.
Spotify. Thank you. iHeart, wherever you happen to listen to podcasting, you'll likely be able to find us under Something More with Chris Boyd. You have to write it all out. Generally, it takes a while to find, but
and rate us.
If you rate us and like us, it'll be easier for people to find, and we'd appreciate that. Make sure you follow so you get the podcast deposited into your, listening wherever you listen every episode, and then rate us and like us so that other people can find it as well.
Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.